Hey everyone, welcome back to Corporate Decoder. Today we're diving into a company that knows a thing or two about buried treasure. Though sometimes it seems like they're digging themselves into a hole. We're going to decode an 8K filing from Odyssey Marine Exploration. It's a story of nearly getting kicked off the NASDAQ and then barely dodging that bullet before we start. If you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where you can discuss all things finance and corporate shenanigans. The main story here is that Odyssey Marine Exploration almost got delisted from the Nasdaq Stock Exchange. Delisting is like getting your membership revoked. It means their stock would no longer be traded on the Nasdaq. That's generally bad news for a company because it makes it harder for investors to buy and sell their shares. On May 7th, Nasdaq told Odyssey Marine that they hadn't met the minimum requirements to stay listed. Specifically, their stock price had been too low for too long. To stay on the Nasdaq, a company's stock price needs to be at least $1 per share. Odyssey's stock had fallen below that and stayed there, and they failed to bring it back up within the given time frame. Usually, when a company's stock price falls below $1, they get a grace period to fix things. Nasdaq can give them 180 days, about 6 months, to get their stock price back above $1 and keep it there for a certain amount of time. In this case, Odyssey had already been given that time, but they couldn't pull it off. The Nasdaq said essentially, sorry, time's up. The company did have the option to appeal, which would have delayed the delisting. That would give them more time to argue their case and try to convince the Nasdaq to give them another chance. But here's where the story takes a turn. As we'll see, Odyssey managed to turn things around just in the nick of time. It's like they found a coin at the last minute. Just 2 days later, on May 9th, the company got another notification from Nasdaq. This time it was good news. Nasdaq said that Odyssey was now in compliance with the minimum bid price rule. This means that their stock price had finally risen above $1 and stayed there long enough to satisfy Nasdaq's requirements. To recap, Nasdaq listing rule 55TT2 is the rule that requires companies to maintain a minimum stock price of 1 TORN. Odyssey had fallen out of compliance with this rule, but then managed to get back into compliance. Back in November of the previous year, Nasdaq had warned Odyssey that they were in trouble. Their stock price had been below $1 for 30 days straight, a full month. That triggered the whole process that almost led to delisting. Because Odyssey's stock price had been at or above $1 for the previous 10 business days, starting in late April and going into May. Nasdaq decided to close the case. It was a close call, but Odyssey managed to avoid being delisted. There aren't any financial statements about business acquisitions in this report, which is not really relevant to the main story. The focus here is entirely on the delisting scare and how Odyssey managed to resolve it. The report was signed by Mark D. Gordon, Chief Executive Officer at TID. Now, let's step back and look at the bigger picture. This whole episode highlights the precarious situation that Odyssey Marine Exploration has been in. Their stock price was low enough to trigger a delisting warning, and they barely managed to recover. This raises some questions about the company's overall financial health and business strategy. Odyssey's core business is deep sea exploration and recovery, particularly of shipwrecks. It's a high-risk, high-reward type of business. They can spend a lot of money searching for treasure, and sometimes they find it and sometimes they don't. That can lead to volatile revenue and profits, which can put pressure on their stock price. The fact that Odyssey's stock price was so close to the $1 threshold suggests that investors are not very confident in the company's future prospects. It could be due to concerns about their ability to generate consistent profits, their high debt levels, or the inherent risks of their business. The fact that the company nearly got delisted from the Nasdaq is a clear sign of weakness. It suggests that the company is struggling to maintain investor confidence and meet the minimum requirements to stay listed on a major stock exchange. However, their last-minute recovery shows some resilience. They were able to turn things around when the pressure was on. One of the biggest opportunities for Odyssey is the potential to discover and recover valuable artifacts from shipwrecks. This could generate significant revenue and profits. However, it's also a very risky business, as there's no guarantee that they will find anything of value. The company faces a number of risks, including the risk of not finding valuable shipwrecks, the risk of being unable to recover artifacts, and the risk of legal challenges from governments or other parties claiming ownership of the artifacts. In conclusion, Odyssey Marine Exploration is a high-risk, high-reward company. They have the potential to generate significant profits from deep-sea exploration, but they also face a number of risks. The near delisting episode highlights the company's precarious financial situation, but their last-minute recovery shows some resilience. Alright, that's our breakdown of Odyssey Marine's latest filing. What's your take on these events and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.